Right. Good evening, ladies and gentlemen. I'm going to slightly turn things on the head because I know we've, actually a lot of the presentations today quite marry into what we do. We are an investment company. We do many of the things that Burford does, obviously not in the legal sector, but in the mining sector, and touch on some of the electric vehicle side of things. But rather than talking about our returns right now, there has been since the beginning of the year, we've been involved with the investment in what we call strategic minerals, which is mainly lithium and cobalt, since around 2013. And recently, Morgan Stanley came out with a pretty bearish report on some of these things. And people listened because it was Morgan Stanley, but they really, because the markets like lithium are fairly complex, they really missed a beat and really didn't understand what they were talking about in terms of, like some of the presenters have mentioned, development timelines. But I want to talk a bit about, their understanding of uptake of electric vehicles as a very linear model, but really to show people that that's not the case, because electric vehicles and to some extent peak power solar panels associated with batteries are really going to change the way that we operate and live our lives. Long disclaimer, you can read it at your leisure. So what I want to take you is sort of, into the future. I'm not talking about 40 years in the future. I'm talking about 10 to 15 years in the future. That's how close this penetration is going to happen. And also, I want to tell you about how sometimes forecasters get it incredibly wrong. So this was a quote by Henry Ford's lawyer saying that electric vehicles, not electric vehicles, the petrol vehicle, the internal combustion engine, was a fad. There was nothing that happened. After all, they had been driving around and transporting people for 1,000 years in the horse-drawn carriage. And when you look at his environment, this was the Easter Day parade, and people who know me, I put this out there because it's a really important image to show what happens when you get something that's a disruptive technology. Easter Day parade, 1900, Fifth Avenue. And I'm not going to ask someone, but can anyone really spot the internal combustion engine? And it's very hard, low resolution, it's there. That's it. There's one internal combustion engine, and then in 13 years' time, can you spot the horse-drawn carriage, please? It is there, but it's not even recognized. They've disguised it. It's that there. So in 13 years, you've gone from 100% minus one penetration of a horse-drawn carriage, which has been around for 1,000 years, to a complete penetration of the internal combustion engine. And why did that happen? It happened because it was a disruptive technology. A technology, not because it's greener, not because it's, it's a fad. It's because it's economically a much better solution to the problem of transport. And I want to talk about how people get that wrong. This is the cell phone. And this was a disruption forecast. This was a cell phone in 2000. Well, sorry, a bit earlier than that, actually. AT&T hired McKinsey, probably charged about $5 million, to tell them in 2020, AT&T were the biggest monopoly of communications in the world at the time. And said, by 2020, what is going to be the penetration of cell phones? Their 15-year prediction was 900,000 subscribers. And we all know that's incredibly wrong. So, that's really wrong. That's 120 times out. And that's because they saw it as a linear adoption, almost like going from a petrol to a diesel vehicle. There was no real change. They thought no one's going to do it. And the fact here is that AT&T had the access to develop cell phones and do it themselves. They basically missed out on $1 trillion market because they got this wrong. So experts don't get this right. And as you can see in many examples through history, when it's disruptive, it will penetrate the market in 10 to 15 years, have 80 to 90% penetration. Why is that? Are electric vehicles, in our case, what we're going to focus on, are disruptive technologies? What are the common factors? So we all know, we should know what Moore's law is, which is basically it's an exponential improvement in costs So effectively, a $600 iPhone in 10 years' time will have 10 times the processing capacity and still cost the same amount. So costs go down per kilowatt hour, well, per processing power. And do electric vehicles have that? Yes, that's already happening. So the most fundamental thing about electric vehicles is the cost per kilowatt hour. So 10 years ago, it was $1,300 a cost per kilowatt hour. It was not really efficient for any of us to get an electric vehicle. We're now sitting, this is old, but we're going to be sitting around, where people believe around 2020, around this period, we'll sit about $150 a kilowatt hour. And most forecasters would suggest, and those that understand business models that are disruptive, that is the cost. Well, it's actually not even that. You just have to do the maths. At that point, it becomes economic for anyone to buy an electric vehicle, not by total cost of ownership, but by its capital cost initially, than anything else, a petrol or a diesel. So when it has that, and when you have disruptive technologies, you get these really massive sort of S-curve developments. We just have to look at the color. Anyway, and you can go back to where it's the printing press, in fact. You can go to the penetration of books in the world, and you just see this massive uptake. And actually, more recently, you can see that this is becoming more and more exponential. I probably don't think it's going to be sort of like the adoption of a tablet, which was vertical, but it's going to be relatively quick and relatively fast once we hit that tipping point. And when you get the convergence of these costs coming together, because electric vehicle is about battery technology, it's about being more efficient in terms of parts. There are only 20 moving parts in an electric vehicle. It's cheaper to fuel because it's about 5 to 10 times cheaper, and it's cheaper to maintain. When you get these convergent costs, you start to see 5 to 10 times improvement. And when you see a 10 times improvement in cost structure, you will get a disruptive technology. Just every single time the evidence suggests that. So really what I'm trying to say here is that, despite some people trying to say that there's some still, I still hear people, well, electric vehicles range and all the rest of it. It really is not going to matter because the people who buy it won't care. But as a classic example, the market for electric vehicles in the UK is very much, and Western world, is actually pretty well dominated by a certain income base and class. So it's really quite expensive vehicles, Teslas and such. If you go to China, the new millennials, or the millennials, are buying their first electric vehicle, and that's their first vehicle, but they don't really care about the range because the reality is 90% of the time, they're going to do 20, 30 miles, and they can charge it. And these are cheap electric vehicles. So we have to understand and not be constrained by our understanding of business models. Any successful business model that is going to penetrate the market has these characteristics. There is another one, which is the convergences of technologies, which is why the iPhone basically replaced the cell phone, because it had the convergence of a touch screen and apps, incumbent apps. So we really like this, and we've looked at the electric vehicle forecast, and we've been believers in this since 2013, really. And when I talked about linear, well, let's look at some linear forecasts here. I'm not saying maybe their forecast out here goes vertical, but I'm really thinking these are actually quite conservative forecasts. 23% penetration rates by 2025. People are suggesting that really understand disruptive technologies. That's going to be sitting 60 to 70%. Really rapid. Now, the problem with that, of course, is one thing that we had beforehand is how quickly can things come on demand in terms of mining projects, because you do need resources. Copper's one of them. Lithium's definitely one of them. Cobalt and nickel are also really important in that. So bear in mind that one of the things I published was I was saying one of my worries was actually the constraint in uptake could be the production cycle of these projects coming online. And we can also see, and I'm now focusing back on the lithium-ion battery, that in fact, we can see the commitments increasing, and this is from Benchmark Mineral Intelligence, they're a really good group, how much the increase in 10 times or 9 times increase in the period of 4 years in the commitments of battery gigawatt hours. Put it this way, when we started, there was about 35 gigawatt hours, which is all the batteries that we needed for every cell phone and all the rest of it. These are the commitments in terms of what people are talking about. That's a 9-fold increase in 4 years, because these are big cathode manufacturers making commitments. I mean, they haven't built them yet, but they are being built over the last, tracking this out, what the Mega Factory Tracker over the last 4 years. So there is both capital flowing and there's both an argument in terms of the history repeating itself in terms of disruptive technologies. So why lithium, and for us, our investments stick around? Lithium, rare earths, and cobalt. Why there? Well, although lots of these have ample minerals resources, they haven't been developed quickly enough to come on demand. So we're going to see pricing pressures. And I'm quite commodity agnostic, so I look for these things in commodities. No replacement. Certainly in lithium, we were at a conference and we were talking to the Bosch, one of the large, well, actually, Bosch, one of the larger developers of batteries and lithium-ion batteries. He said the next lithium-ion battery is going to be a lithium-ion battery. It's just going to be more lithium in it. It will be a lithium air, but really they're mostly going down what they call this nickel, metal, cobalt technology and phasing out a bit of cobalt, still required for the stability, and putting more nickel in it. So the ratios are going, and that will be in the next 5 years. But ultimately, if you really want to get there, which is theoretical, which is lithium air batteries, they're almost equivalent to petrol. And we're not in a cycle. We're not in a commodity cycle. This is not about increasing GDP in China. It's about a change in the way that we move ourselves. And UBS came up with effectively, bearing in mind this is a 100% EV world, but nonetheless it showed that the three most important aspects to fund that were lithium, cobalt, and rare earth. Rio Tinto, who's not really involved in the lithium, actually they've got one asset they're still developing, would put tin in there as well. Actually, one of our assets is basically tin and lithium. So as you can see there, we are in the right sector. There is the drivers for it, and we can see that the lithium supply, these are our own models, by the way. We look at most of the projects out there, pre-feasibility, feasibility projects, and look at where we think the supply and demand goes. Now, I would say that we're a bit more optimistic than some in terms of the supply, because this is the supply curve. You can see, there's maybe a bit of surplus here. And this is taking a relatively conservative, this is about 23% penetration rate on electric vehicles. But the reality is, and there was a great slide, was a lithium conference by the JOLSOC, is that there was a forecast by Roskill about how much tons of lithium carbonate will be out in the market. It was made in 2010. They forecasted that there was going to be an expansion of 100,000 tons of lithium carbonate. Bearing the market, so that was a 50% increase, bearing the size of the market at the time was 200. Of that 100,000 tons, guess how many actually made it to market? 19,000 tons. That's because projects, whether they be early stage projects, the success rate, this is the thing to know, the success rate of early stage projects to come to production is in a ratio of around 2 in every 3,000. So it's important to understand these projects, and so that's why I say that's probably a bit on the optimistic side. So, we see lithium as a real key driver. And when we've got the lithium pricing, when we got invested, it was like 4,000. You can see that pricing has increased quite dramatically, and all our investments are sort of at the pre-feasibility or feasibility stage, and they've priced their pricing at $10,000 or $11,000 a ton. I had an interesting conversation someone came up to me and they said, lithium pricing is a speculative boom. And I said, oh, really? Why do you say it's speculative? What makes it speculative? Well, because people are buying it, they're storing it. And I said, well, none of those apply. Lithium hydroxide, it costs you more to store this stuff, and who would you sell it to? Because it's not a commodity, let's be clear. This is not a commodity. This needs to be, when you produce a lithium carbonate product or a lithium hydroxide product, you need to have a buyer that wants that product at those specifications. Each buyer will have different specifications. So there's no possibility of hedging, forwarding it, and creating a speculation in terms of pricing. And there's no possibility of hoarding it because it costs more to hoard and now you won't have anyone to sell it to. So that theory is wrong. I would say that there are some speculations in the pricing of lithium companies, but fundamentally that pricing is a pretty good understanding. And while we have still this deficit, that pricing is going strong. Morgan Stanley is saying the pricing will drop by 45%. Actually, in January, it increased again by about 1 or 2%, lithium carbonate, lithium price. So the slides are slightly odd, but I've talked about lithium. I've talked about what we do. I haven't really talked about what we do. So we invest at early stage. We realize that the risks are there, as I mentioned beforehand, when you've got those ratios of 3,000 to 2 to get to a sort of PFS level. We look and we assess them. We do very much. We get about 300-400 projects through our business every year, and we haven't invested recently in many because we thought they were slightly overpriced. But we take our due diligence seriously. An idea is to find undervalued assets with irreplaceable competitive advantages, which is generally about the cost curve. So even if the lithium price should go down, or the cobalt or any other prices should drop, we're protected because they would still be positive NPV going forward. And we've developed a strategy that's slightly changing over the last year. We have two sets. We have a direct project investments. We'll invest directly into the project, de-risk our investments by basically taking a stage approach. So we will effectively say, OK, you need to get to X stage, and we'll put the next set of money in. And it's our option to do that. And we work with management to drive that value. So our experience within, particularly in lithium, and our experience and understanding of the market, our contacts in places like China, where the majority of the off-takers are, we will try and expedite that and also tell them where they really need to focus their efforts in the development of such a resource. And that's typically early in the pre-resource and maiden resource. Public listed investments, that's pretty well been part of our history. We invest up to 30%, and it's early in the early to medium development cycle. And we diversify our risk because we take equity positions so we can liquidate that and deliver the returns. That's where we are. For clarity, the reds are the public listed, the blacks are the direct project investments. I think the most famous that we're probably involved is in Cadence Minerals, which is coming into construction this year, subject to finance and production 2020. That's got a NPV of 1.25 billion. We also have, it's on embarking on its definitive feasibility study, European Metals Holdings, which has an NPV of about 540 billion at PFS. The others are, and you can see where we look to make our investments, and really we're not structured, we don't have the capital to start funding construction and commissioning. We take those risks here, where the largest, and these are risks that we can understand and control a bit more because they're all about technical risk. When you start to getting into here, there are external factors of risks that you might not be in control, whether that be governmental, political, environmental, changing governments and such like that, which can really affect the pointy end of development, and sometimes where a lot of projects fail because they lack financing. So what's the value proposition? We're not a large company. We've got market cap around 20 million at the moment. Our investments to date have been around 15 million. The value based on our JVs and understanding the NPVs from that and re-rating those, readjusting that to reflect the market cap is around 33 million. Our return as of December was 121% over that period, which is similar to compound annual growth rates you'd see over private equity over that same period. And what is the potential? Well, if we assume that we get diluted, I'm making an assumption we get diluted on when they do the bankables, you've got about $130 million worth of possible value for us on those projects. So go quickly, really. I've got short public listed investments. I think I've talked a bit about those. You can see Bacanora and European Minerals, both really lithium. That's lithium and tin. Auroch Minerals is actually just slightly out of date. They've got involved in a cobalt project, and we've also got, they're mainly involved in the cobalt project. These are the performance of those public listed investments. You can see those returns, and we take a lithium index. We outperformed during this period. This was when EMH had a massive spike prior to PFS, and we're slightly above it now, bearing in mind that actually the lithium index has probably come down now since for the first 3 months because partly of some sort of, I'll have a conspiracy theory about people wanting to do that, but ultimately we still outperform that. And you can see the key investments, the size. They're both similar sizes. They're both got these OPEX are low in the quartile when we show that. CapEx are fairly large. And the NPVs are substantial as beforehand with reasonable rates of internal returns. I want to point out, again, lithium prices are sitting around 15,000. It depends where you go, but I'll say FOB in Chile is around 15,000, which is the most, probably the more conservative market. These are only priced at 10 or 11, so there's plenty of upside there still. And our investments sit in this. These are the biggest producers in the world, SQM and will be. We have a small investment in them, actually. Our cost curves sit out there in the European metals and Bacchanal. Similar cost curves, protected any downside. And I suppose, just to illustrate, this is actually from EMH's European Metals Holding, which we hold 20%. Really seeing why strategic location is important. The Sinovac asset is right in the middle of where the electric vehicle boom is going to occur. And let's not make a mistake. When they talk about battery plants being built, yes, the large majority are in China, but there's around 20% going to be built in Europe and the remainder in the United States. So we've got a bit more into direct projects. This represents our Mexico. We have a JV there, so to us that's probably worth in the region if around the $30 million mark. But really, we're starting early exploration here, and we're going to be. Our view is, as we divest from these, is to reinvest that, try to deliver the same amount of returns in terms of equity returns on that investment going forward, and that's what we intend to do. It's all about capital growth for us going forward. I realise I've got very little time. This is, you can look these up. This is our San Luis project. It's early stage. Great pegmatites. It's a great area to work going forward. And we're still waiting for some licenses to be granted, but our exposure is minimal because until those licenses are granted, no expenditure is required by us. That was the plan. We've already started some prospecting program. Idea, assuming license granted, to be H2 drilling. And just if that was successful, there's a really, if you look at the enterprise values of a lot of these pegmatite deposits, if you wanted to target something like 25 million tons at 1.2% lithium, the enterprise value compared to the market would be around 300 million. So again, there's plenty of upside, assuming that we can deliver mineralized resource of that size, and that's what we'd want to be targeting. So, I think we're posed for upside. The market cap's around 20 million. 2 projects that between them have around 130 million of value to us in terms of dollars. The market really hasn't attributed value to these unlisted projects. And there's strong news flow. Even I didn't update this. Two announcements around one around Auroch and one around Clancy, where one was getting involved in a cobalt and the other one in a copper project, which can provide news flow for us. These analyst valuations are pretty old, but I put them up there for disclosure.